They don't want you to know. I'm your host, Steve Van Metre, and thanks for joining me today. In our lead story today, we have some new data that confirms that the big banks are intentionally trying to crash the housing market. We're going to take a look at what their plan is and how they intend to profit from it. Plus, we have a sponsor for today's show. I'm going to give you 7 reasons why you may want to add this stock to your portfolio, including a chart setup that shows that this stock is poised to zoom higher. Let's head over to Bloomberg, where we picked today's story up with a headline: U.S. home purchase applications drop to a 28-year low as rates jump. Now, the reason this story is important is because the big banks make big money originating new home loans and refi loans. So when you see this crashing, it tells you their bread and butter profit center is plummeting. And of course, that means that they've got another plan in mind, as you're going to see, to bring housing prices down. And of course, that will trigger a massive bailout and even bigger profits for the banks. The index has declined more than 18%, the most, get this, from 2015, even though rates are still nowhere near their 28-year high. And when we take a look at this chart, we hear from Bloomberg, we see U.S. mortgage applications for home purchases are dropping sharply. Again, we're down to levels not seen for 28 years. But mind you, the last time we saw mortgage applications that low, the rates on mortgages were north of 8%, and we're nowhere near that. And it doesn't even limit itself to home purchases. However, we see that refinance applications fell 2.2% last week to a 3-week low. The gauge of overall mortgage applications has now dropped more than 13%, the biggest slide since the last week of September. So we can know that coming forward in bank earnings announcements, they're going to be terrible. But you've noticed, what have we heard from the bank CEOs? Everything's fine. The consumer's in great shape. We're doing A-OK. In fact, we think things are going to be better than you believe, but underneath, they actually know what they're deliberately intending to do here. And I want to show you on this next chart what their part of their plan is, and they're doing it by tightening lending standards. So here you can see in this chart the net percentage of domestic banks tightening standards. We're looking at not just commercial industrial loans, credit card loans, auto loans, loans to small firms, government mortgage loans, and GSE eligible mortgage loans. And what I want you to note here is that anytime these lines are above the horizontal black line, it indicates that lending standards are tightening. So what do we see going into the dot-com bubble is lending standards start to tighten. You get a recession. The Fed, which we'll look at, will eventually ease rates, and they will still be tightening, but at a slower rate until they ease. And you'll notice the next expansion, you see a period where lending standards are easy, where they're loose. And then they tightened up again going into the great financial crisis. They tightened into the pandemic and came crashing down as the government doled out money. But look how short this is. We look at the last expansion and note that the banks kept lending standards broadly fairly easy throughout most of the time. But now look what's happening. They're shooting straight up. And of course, we know the government's going to respond as the U.S. cut mortgage insurance costs for some new homeowners. And no surprise, the borrowers with mortgage insured by the Federal Housing Administration will see their fees cut by about $800 a year, or 0.3 percentage points, according to a White House fact sheet. Now, of course, we know that the government is worried about the housing market because the housing market is the economy. And they believe that people just can't afford their mortgages, and that's why they're not buying new homes. But I want to suggest to you that $800 is somewhere around $65 a month, $70 a month. That is not enough of a difference that someone's going to say, hey, you know what? If my payment was just a little bit less, I would be all in on this purchase. That's not likely, but it already tells us what we can see from this current administration, that if something goes wrong with the housing market, well, guess who's going to come and bail them out? You got it, the government. And of course, everyone's going to point fingers at the Fed, and along with the banks are going to say it wasn't us, it was the Fed. But I want to suggest to you in today's show, it is part of the bank's plan. And here we see Bullard still favors hiking rates to 5.375%, well, just as fast as possible. He says, I think we're going to have to get to north of 5%, and right now I'm at 5.375. We've got a little ways to go here, and I've argued, hey, let's get where we want to go, and then we can see how the data comes in, and hopefully we'll we'll get some disinflation in 2023. So the Fed is sticking its neck out there saying, look, this is all us. It's our problem. We're going to fix it. And from the bank's perspective, go back to the great financial crisis. They took the blame. This time, they want someone else to. But again, I want to suggest to you, they're the ones that are manufacturing the slowdown in the housing market, and they're the ones that are going to crash it, not the Fed. Let's take a look at this next chart. And we have the same net percentage of domestic banks tightening standards for all the same reasons we looked at before, but now I've got the federal funds rate, and I put that in this big, thick line, and what I want you to see is banks tighten standards. What happens? The Fed starts to pause and then ends up cutting rates as credit gets too tight and slows the economy down. You see that going in the great financial crisis. The banks had barely started tightening standards, and the Fed went back into pause mode. How about in 2019? The banks were about halfway between some tightening and some easing, enough just to get the Fed to pause. Today, the Fed says they've got to go higher, and you can note that lending standards are getting tighter. So now let's look at where this is going in the housing market, because we've got some data that validates everything here as part of the bank's plan. They want to slow this down. They want to crash prices, and wait till you hear why I think they're doing it. U.S. housing starts drop a fifth month, now the longest streak since 2009. Of course, we know that is bad news in itself, as residential starts decreased a whopping 4.5% last month to 1.31 million annualized rate, marking the longest stretch of decline since 2009. And of course, we can think going back to 2009, we know we were in a recession. Now let's look at some data here. Let's take that same chart and look at home sales here and see, or home starts, and see what this looks like, and see how much of an impact the banks are having. And again, I want you to understand, this is nothing specifically to do with the Fed, but they're the ones that are going to take the blame this time. Here we can see new privately owned housing starts overlaid again with the same net percentage of domestic banks tightening standards. And what do we know? That when banks tighten lending standards, we see housing starts come down. We see here again, banks tightening standards, housing starts come down. Banks start to tighten standards, housing starts come down. We see it twice, once here around 2019, once going into the pandemic. And so what do you think is going to happen again? And this is a supply and demand issue. Suddenly, housing starts go down. People say, I can't afford it. And then next thing you know, what are builders doing? They're cutting their prices. What does that impact then the resale market? They start to cut prices. You get layoffs. You get everything slowing down. You get less credit creation. You get a recession, and prices come falling down. And you'd think the banks would be worried about this. Well, I'm going to tell you why they're not here in a moment. And then today we see this, U.S. home sales post 12 straight monthly decline. Again, the belief is, according to the White House, which we saw earlier, hey, this is a pricing issue, but no, it's a banking issue, my friends. Housing price inflation here is cooling as existing home sales fell 0.7% to a seasonally adjusted annual rate of 4 million units last month. Here we go again, the lowest level since October 2010, when we were dealing with a foreclosure crisis. So here we see it just once again, that the home sales are coming down. Everyone's saying it's due to rates, but I want you to keep in mind, if the economy was indeed booming, rates should not be an issue. People should have enough wealth, should have enough prosperity, should have enough optimism in seeing their wages rise, where even if interest rates go up and the payment goes up a little bit, or in that case, the $65 a month that the White House is suddenly worried about, it's a non-issue to people. But now let's take a look at this next chart, because I want to show you why housing prices, because of the banks, are coming down. And here we can see the average sale prices of houses sold in the United States. That's in that big, thick blue, kind of grayish blue line against, of course, the net percentage of domestic banks tightening standards. And what do we note? That when banks tighten standards, here you can see in the dot-com bubble, prices, just the average price just flattened out. And here we can see again, going into the great financial crisis, banks tightened standards. The average price at first flattened out a little bit and then came crumbling down. We see them start to tighten lending standards here around 2016 through 2019. What happens to price growth? It slows. It still grows a little bit, but it slows. And now then what happened during the pandemic, of course, banks tightened standards, housing prices flattened out, started to come down. The government runs to the rescue, solves all of that problem, and here we are again. And you can only imagine where prices are headed next. Is they're likely headed lower because the probability here that banks are going to start easing lending standards is pretty close to zero. They have no incentive. They know the economy is slowing. They know people are out of money. They know wages are not keeping up with inflation, and they have no incentive to do this because if you think back to the great financial crisis, what did the banks do? Well, they profited off of the collapse in the housing market because the government stepped in. They had all these mortgages insured by Fannie and Freddie. They paid the banks. The banks then turned around and foreclosed on the property anyways. And what did they do? They turned around and they spun those properties, sold them off to who? Major investment companies who bought the homes up, lock, stock, and barrel. And that's their plan, is they're going to spin these houses off just like they did back to the rich, to the big, powerful corporations who are going to make everyone end up renting, and the banks will come out ahead because the government can't let the housing market fail. And now you see why they don't care at all. But one thing you might want to care about is our sponsor for today's show. Let's take a look at Genprex, and they're programming the course for cancer and diabetes. And we'll put a link to their website, genprex.com. Their stock symbol, GNPX. You might want to add that to your hot list. And we're going to look at our analyst research report. We'll put a link to that again in the description and as a pinned comment, because we know anything having to do with cancer and diabetes is big money. And if there's a breakthrough, of course, you know these stocks overnight can just go straight up. Our mission is to develop life-changing gene therapies for patients with cancer and diabetes through unique, innovative science. And wait till you see, if you think what they're doing here is cool, wait till you see the chart setup we'll get to here in a few moments. Genprex is a clinical stage gene therapy company focused on developing life-changing therapies for patients with cancer and diabetes. Again, we know with all these boomers heading to retirement, the cancer and diabetes, when they get it, they're going to want answers. Genprex is one of the leading technology companies that have designed to and administer disease-fighting genes to provide new therapies for large patient populations with cancer and diabetes who have limited treatment options. And now let's take a look at the 7 reasons why you may want to add Genprex, symbol GNPX. Again, it's NASDAQ listed, to your hot list and maybe your portfolio, as it could be poised for significant upside potential in 2023. According to Jason Colbert, Director of Research at Dawson James, he initiated coverage on Genprex with a $3 target. At the time, he noted it would have an over 114% price move from January 30th to hit his target. Of course, it's gone up since then, so it's not quite as good, but if it hits that $3 target, there's still a lot of opportunity in GNPX, and it's got a lot of trading going on. In fact, it had as much of a 94.85% move in 7 days, when on January 5th it reached an intraday trading high of $1.89. So we know that traders love active stocks. They love stocks that can move, and this one's got the potential to move higher. Although nothing is certain, but keep in mind, it does have the potential, and I will show you, to get to that $3 range. And looking at the technicals, well, according to stockcharts.com, and we're going to look at our own charts momentarily, it's trending, won't say near, above its 50, 200-day, and 100-day moving averages. And we know that when stocks start to get above its moving averages, it can break out in a big way. Now, let's take a look at the chart setup here, because I want to show you there's a ton of support under Genprex, and it's putting it in a position to go a whole lot higher. Again, put this on your hot list, GNPX. Now let's go back and look at the 5-year chart here. we got the volume profile running across. What we note is there's a ton of accumulation going underneath here over the last 5 years. Sellers right above this $3.32 price range, which is where that price target was from the analyst, saying right at around $3. And we know due to the volume, it makes sense. Now let's zoom into the 2-year chart. I've got this purple line across the horizon showing the volume profile. And so what you can see every time it dips down below that, accumulation comes in, buyers come in, and it's looking to make a move up there. So you see it's trading right around $1.70, and it still's got a lot of upside room to retest that upside mark there. And you add its volume profile, which would make a nice return if it just did that alone. But if it breaks out, well, it could go a lot higher, because the last time it got over its 50-day, 100-day, and 200-day moving average, well, it went from around $1.40 all the way up to almost $7 a share. That is a huge price move. And so let's zoom in a little bit more here. What do we see on the 1-year chart? Tons of price support sitting right underneath at $1.40. So current price above that, providing support where buyers are at over the last 1 year. And that is significant. You know, when you're looking at trading a stock, you want to know where the buyers are at, where the sellers are at. That's what the volume profile shows you. It's telling you there's a massive amount of buyers underneath here. And as we zoom further in, you'll see there's even more. Here you can see on the 90-day chart, as we zoom in, there they still are right around that $1.33 level. So there's a ton of near-term support, ton of long-term support here to suggest that GNPX is poised to go a whole lot higher. Here you see the 30-day chart. Again, it was holding that support level there where its volume profile and looking to take off as buyers are continue to accumulate Genprex. And it's got massive market potential. The global gene therapy market was valued at over $2.9 billion and expected to reach nearly $16 billion by 2023. They've got an exclusive license agreement with the University of Pittsburgh. They're on the FDA fast track for their lead product candidate, Rescorza, as it's being evaluated for a treatment for non-small cell lung cancer. And they've got a study coming out the first quarter here, a preliminary data from a more recent study in a non-human primate model of type 1 diabetes. And you know, if good news comes out of that, again, this is NASDAQ listed. This is where the algorithms read the news, and then you know the stock could shoot higher on any positive news release. So again, add Genprex to your watch list, GNPX. Be sure to do your own research. Check out their website. Check out the research report. Do your own charts. And then if you still think it looks good, I'll let you make the decision to add it to your portfolio. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.